If you're retiring with most or even all of your savings in pre-tax accounts, like 401ks or traditional IRAs, then you're not alone. I mean, that's the case for many, if not most people, quite frankly. But here's the challenge. Every dollar that you withdraw from those accounts is taxed as ordinary income. And if you don't plan ahead, you could easily pay more in taxes than necessary, especially once required minimum distributions begin. Having said that, though, recently I did meet a couple. They had saved nearly everything in their 401ks, and they were proud of what they built, but they were worried. They kept hearing and reading that they should have maybe have invested in a Roth and have some tax-free money and things like that. And they thought maybe at this point they had just done something wrong because everything they had was all pre-tax. But when we ran their plan, we found that their RMDs actually fit right into the income that they already needed to live on. They didn't need to panic. They just needed a clear, coordinated strategy now for taking income efficiently. And it's completely normal to wonder if you've saved in the right places, right? To play, Monday morning quarterback, so to speak. But what matters now isn't how you got here. It's how you use what you've built in the most efficient way going forward. Now, most people do what they're supposed to do, right? They save in a 401k, defer taxes, and then let the money grow. But in retirement, that money sits in a tax-deferred account. And when you take it out, the IRS is sitting there patiently waiting. They've been waiting for years. They now want to get their tax money. And even if you don't need that money, or maybe you don't need it all, they then have some rules, right? The RMDs, require minimum distributions, that say, hey, at 73, which is the current age for RMDs or when they begin, this is how much you're going to have to take out based upon what the year-end balance was last year divided by a certain divisor. It says, hey, this is what you've got to take out. And at the end of the day, for some people, it's not a big deal. The RMD is close to what they would have spent anyway. But for others, especially couples, maybe with 2 Social Security checks, maybe a pension, maybe they got plenty of income. Maybe now they also have a paid off home. And now they're thinking, well, geez, yeah, we've saved money in 401k and things like this over the years, but we really don't need much from that. We don't need any of that. Some folks tell me once they hit the age of having to take RMDs. And at that point, what can happen sometimes is that you start to withdraw that money, and then that could cause your Social Security benefits to become, subject to tax. It may not have been taxable before, or maybe more of your Social Security is subject to tax than was subject to tax before, or it could affect your Medicare premiums, maybe cause you to go into that next tier and then get a IRMA surcharge, things like that. The thing is that pre-tax accounts are great for saving, but they're tricky for withdrawals. RMDs are based on both your age and your account size. It's not what you actually need to spend. And every withdrawal is then taxed at ordinary income rates. It's not the lower capital gains rates. Now, if your planned spending is about the same as, or if it's higher than your first RMD, then RMDs probably won't be a big issue. You'll naturally be taking out what you need. And, the key here is to simply be mindful of how each extra dollar can affect your taxes. Even if all of your savings are pre-tax, small changes can matter. If you go just $1 over an IRMA threshold, for instance, then your Medicare premiums could jump. And with Social Security, adding an extra dollar of income can sometimes cause another 85 cents of your Social Security benefits to become subject to tax. So that single withdrawal effectively adds, single withdrawal of an extra dollar could then add another $1.85 of taxable income. One way to plan ahead is through bracket fill withdrawals or selective Roth conversions during lower income years, while also keeping an eye on IRMA cliffs. And that means taking out, maybe a little bit more on purpose while you're still in a favorable tax bracket. Maybe you're right there at that 12% tax bracket is a scenario where if you don't realize that additional income and take out that additional money and you keep deferring it, maybe in the future you'll get bumped up to maybe that 22% tax bracket, just as an example. One quick note for couples, after one spouse passes away, the filing status changes to single, and tax brackets and also IRMA thresholds shrink. And so the same income minus maybe one Social Security check, the lower one, right? As married couples, you'll keep the higher of the two when one spouse passes away. This could still mean higher taxes and these surcharges. Now, no matter which bucket you fall into, the key is not to just plan for this year's tax bill, but also for your lifetime tax picture. And if you retire, let's say in your early to mid 60s, and you delay your Social Security, you might have a few years with very low taxable income. And if you do, that's considered your tax sweet spot. You're not working, you haven't started Social Security yet, your income and your tax bracket are low. And you could use this time to take strategic withdrawals from pre-tax accounts and to reduce future RMDs and to smooth out your lifetime taxes. And you could fill the 12 or maybe the 22% tax bracket, just kind of depending on your tax situation and things like that, and maybe pay a little bit of tax now to potentially save more later on. Even if you don't do conversions, plan withdrawals that fill the bracket can trim future RMDs and help manage IRMA. Now, you can move money from a traditional IRA to a Roth by doing a Roth conversion. And you would pay the taxes now, of course, and then the money would grow tax-free later on. Conversions can make sense when your current bracket is meaningfully lower than what you expect it to be down the road. Or if you want tax-free income that won't affect Medicare or Social Security taxation. But conversions aren't a one-size-fits-all deal. Sometimes the upfront tax cost, it outweighs the benefit, especially if your RMDs would have been modest anyways, or maybe the money won't stay invested long enough for it to even matter. Now, you don't have to convert everything. That's another thing here. I mean, even small, maybe, just small consistent conversions each year, taking a look and being very thoughtful about how much you're converting, depending on where you are within the tax brackets, could make a meaningful difference over time. The real goal ultimately is flexibility and having both pre-tax and tax-free buckets so that you can choose, where to draw income from each year. Don't convert just because the internet said to. Too often I find Roth conversions, get a little bit too overhyped. I mean, don't get me wrong. For some people, they absolutely make sense. For other people, not so much at all. You got to run the numbers and make sure that it fits your situation. And don't let RMDs dictate your plan. Create a multi-year strategy that coordinates how much of your income that you're going to need each year. When you're going to start Social Security, what your tax bracket is today, what it most likely is going to be tomorrow and into the future. And also taking a look at your Medicare premium, since IRMA is based on income from 2 years prior. And sometimes taking a little extra early on could keep you in a lower lifetime tax bracket later. You can even withdraw more than your RMD if it helps manage future brackets, or if it creates room now for conversions before income rises. And another thing is, if you give to charity anyway, QCDs or qualified charitable distributions, these are available once you're 70 and a half. And these can satisfy RMDs without raising your AGI. And this is where good planning really pays off. It's not just for this year, but for the next decade or 2 or 3 throughout your retirement. Now, before we wrap up, let's talk about 2 hidden tax traps that catch people off guard, even those that thought they had planned for everything. Now, Social Security first. So Social Security benefits aren't automatically tax-free at the federal level. Now, they are if you don't have other income, but the thing is, they're not automatically 85% taxable either. It depends on your provisional income, which is your AGI plus any tax-exempt interest, which is like municipal bond interest, plus half of your Social Security benefits. And the confusion that comes up more often than not, and I'll take the case of a married couple, the highest bracket there is $44,000. And it's looked at and says, well, the misunderstanding is that if income is above $44,000, or even if provisional income is above $44,000, that you're going to have to, that 85% of your Social Security benefits are going to be subject to tax. But that's not necessarily the case. Okay, as that number rises above that highest threshold there, then a larger portion of your benefits will become taxable. But again, it doesn't mean that everyone over the threshold pays taxes on 85% of their Social Security. As an example, a married couple with around $50,000 of Social Security benefits and $30,000 from an IRA might have provisional income around $55,000 in that case. And even though that's above the $44,000 threshold, only a portion, maybe about half of their benefits would then be subject to tax. The takeaway is that it's not about hitting a cliff with Social Security. It's about how each new dollar of income then gradually pulls more of your benefits into the taxable column. Now, with Medicare premiums are based on your income from 2 years prior. And if your modified adjusted gross income crosses certain thresholds, then you'll pay a surcharge on your Part B and your Part D premiums. And sometimes it could be hundreds of dollars per month. And here's the tricky part. If you go just $1 over a threshold, and then you would be bumped into the next tier. So it's not like a marginal tax bracket thing where some of your income is taxed at 10% and some at 12%. Once you're in that new tier for IRMA, then you're paying the higher IRMA surcharges for Medicare for that year. I once worked with a couple, and they were just a little over the Medicare income threshold a couple years prior, it turned out, after a meeting and getting together with them. And unfortunately, it ended up costing them several $100s more in premiums that year. Now, at the end of the day, what they could have done, because they did have this, they could have taken that extra money from their savings account as opposed to from their IRA to meet their expenses that they wanted to pay for. And it would have kept them under that Medicare IRMA threshold. But at the end of the day, it's not the end of the world. I mean, yes, it is more money. We don't want to pay that IRMA threshold. Don't get me wrong. But it wasn't going to completely derail their plan. It's just another thing to be mindful about and to be considering. Now, here's another thing for those of you that are concerned about what happens ultimately when you're not here and when the money does end up going to the kids. Well, under the current Secure Act rules, most non-spouse beneficiaries must empty their inherited IRAs within 10 years. If they're still working and already in a high tax bracket, then those withdrawals can then maybe push them into an even higher tax bracket, perhaps, and so it would cause them now to pay even more in taxes on that money. And that's just another reason to then plan withdrawals and conversions carefully. It's not just for today, but could also be for the next generation too. Again, depending on your situation, what you ultimately want your money to do for you. And remember this, retirement isn't just about the numbers. It's about peace of mind. When you know your taxes, income, and investments are all working together, then you can focus on enjoying the years ahead. Plan early, coordinate income sources, and review as your life and the laws change. And if you'd like help building a personalized, tax-efficient retirement income plan, there's a link below to schedule a strategy call with me. Now, whether you work with me or somebody else, the key here is to have a clear, proactive plan, not just for investments, but for how you'll take income in retirement.